Good day, folks. We continue on Module 2 here in Week 2, looking at the relationship between revenues and costs. As I've said multiple times, this is foundational. A lot of what we're going to do for the following 4 weeks is based on this. A clear understanding of this will help you be successful in the rest of the class. So we're going to literally pull it all together. We talked about revenues, we talked about costs. Now let's look at them together. The first thing is to introduce this concept of cost, volume, profit analysis. And we're trying to examine the relationship between sales prices, production, volume, cost, expenses, profits, and how do we use this information in our day-to-day work in running a business. It's a very dynamic thing, is that business is dynamic. So we use it a lot in decision making within the firm, is that firms are trying to make fact-based decisions. So we can look at the effects of changes in selling prices on profits, changes of costs on profits, changes in volume of production on profits, setting selling prices, selecting the mix of products to sell, and then choosing among strategies to implement. Now, if we come back, the first module talked about the revenue, the sales in units and in dollars. We start to pull that all together as part of this decision-making process. So we're not doing it just to create a report, we're using it to make decisions. Now, depending on whatever your career direction is, you may not be accounting, but you will be involved, and no matter what you do, in some of these things. Okay? So keep this in mind. This is useful information to help you be successful over time, no matter what you do. I want to introduce a few new terminologies here. And one is the contribution margin. And that's the excess of sales over variable costs. So we have the contribution margin, sales less variable costs. This is what's left over to impact the fixed costs. Now, I'm both in the overall I'm a more financial analyst, financial statement analysis, analyzing companies, so I tend to probably look at things in a slightly different view, but the foundation is clearly based on this. But when we're looking at a detailed managerial accounting system, we focus on this contribution margin. How much is the operations contributing to the fixed cost of the operation? Now remember, in financial accounting, we may be more focused on presenting financial information, and we may not do it this way. But that's okay. We'll talk about that as we go. The contribution margin ratio, okay, this is the margin, this is the ratio. Now, one of the things is important is that when we see things on a graphical basis, and the ratio is expressed as a percent, but when we start looking at the contribution margin, we can see that it's a function of unit volume. So that the more units we produce, sales go up, but our variable costs go up, but the contribution goes up. And that's more available to cover fixed costs. If fixed costs remain the same, this chart shows us that it will be growing. Okay? So we use those two pieces of information. That enables us to determine the contribution margin income statement. This is not GAAP, this is management accounting. So we start out with revenue, we subtract variable cost, contribution margin, revenue less variable cost, less fixed cost, gives us income. The alert student may want to remember this slide as we move forward. Let's just take a sample here, and all the names change. I don't know why they do this. I have to modify half the slides that I get because it just doesn't make sense to me. It's too much on a slide. But here you have an example. Sales are 50,000 units. Sales price per unit 20. Variable cost per unit 12. And then fixed costs. So you go to construct the contribution margin income statement format. You got your million, 50 times 20. Variable cost, 50 times 12. Contributing margin, 50 times 8, which is the 20 minus 12. So by selling 50,000 units at that price, with that cost, the contribution margin is 400, our fixed cost, and we can determine income from operations. Now, the rest of what we're doing from a planning analytical perspective is going to be looking at what happens when some of these change. Okay, what's the effect on profit, income from operations? But we can also work backwards to figure out if we want an income from operations to be X, what do we need to do? So these are all the variables that go in there. And all the modeling that we do to help make decisions again is to modify these and see what the impact is. So here again is just a comparison of the contribution, which is used primarily by management, primarily for external reporting, which is guided by GAAP. Management accounting is guided by management needs. So we all start out with sales. Okay, same thing. Net income turns out to be the same thing. There's no difference there. It's the way we look at this, and in the cost of goods sold, gross margin, selling, admin. In the contribution format, it looks at it as variable versus fixed. Okay, that's the fundamental difference. Same things, just cut a different way. Now, what do I look at? Well, here's the blending of it. I start with sales, same, cost of goods sold, but I break the cost of goods sold down into a variable and a fixed. Okay, because I still think it's important to see the total cost of goods sold and the gross margin in percentage. It's better, it's good for identifying trends. And it's also good to be able to look at the production versus the administration of the company. And I then have my selling in general. That includes their period cost, okay, as we previously discussed. But they're both fixed and variable. So 100 pre-tax income, income taxes, net income, net margin, which is the net income divided by sales. So essentially this is just a slight modification on this contribution format and blends the two of these together. Again, it's management decision. If I were running a company, I'd probably do it that way. But this just shows that you can adapt managerial accounting to what the needs of management are. Now, the next thing that comes into play here is the unit contribution margin. And oftentimes that's used for determining the profit potential of proposed decisions. Okay. And the unit contribution margin, selling price per unit minus variable cost per unit. All we're doing is taking the contribution margin and converting it to units. Okay, that's all we're doing. Okay, so that we can look at it on an incremental basis. What if we do this? What can be the impact? So we're going to a little more finite detail to look at the on a unit basis. So if you're looking at Molson Coors, that is going to be on a hectoliter basis. Okay, so it's just taking us to a finer level of detail. Don't over-engineer. Okay, contribution margin divided by units. That's really, sometimes we over-engineer it. We get into such minutia that it doesn't add value. Remember, in management accounting, we need to add value to a firm, not just produce information that isn't used. What we do find, though, is that the unit contribution, when we're looking at the increase, decrease in sales volume and it's measured in quantities. The change in sales volume multiplied by the unit contribution margin equals the change in income. Okay, so now a lot of times I may be in a production capacity or sales, and I need to figure out how much do I need to do. And that way I can figure it out. Is the change in income from operations is a function of how many more units I sell or produce times my unit contribution margin. Okay, so if I want to figure out what's going to be my change in income if I produce 1,000 more units. So here it is, example, change in income, 15,000 units, that's what I'm going to change. My unit contribution, which I historically is 8, I increase my income of 120. So that's how we use it, because it becomes very tactical and it's useful that way. Next thing to take a look at is the break-even point. And a break-even point is when revenues equal costs. Now, that's a minimum. As a business, we can't stay in business if revenues equal costs. Okay? That's just sort of a basic thing. But we like to look at it at what that break-even point is. And by definition, that is simply the level of operations at which a company's revenues and expenses are equal or they offset each other. At that level, you're neither profitable nor loss. Okay? And from a mathematical perspective, that's computed by taking the fixed cost, total fixed cost, which is known, divided by the unit contribution margin, and that will tell us our break-even sales in units. A lot of this coming back to units is because we're making sales decisions, production decisions, and we always are making something. This is true in every type of industry, from sales to service to production. Okay, and service is a good one. If you're looking in the accounting field, you sell hourly services. Okay, and if you want to make more money, you have to sell or bill clients more money per hour. So we compute this. That's the break-even unit. Now, let's take that beyond the very simplistic thing. Once we understand that, and we're going to look at things graphically, managerial accountants have done this for a long, long time, but it's now becoming more used because it's data visualization. We can see things and we can see the relationship between things graphically before just giving you all the wording doesn't work. I mean, I could talk about this, and unfortunately I will, but here's a break-even analysis. This is the point that our revenues, which is on this line, follow it up, and our costs, which are on this line, are even. Okay, so now let's look at what the X and Y axis is. So here we have units sold. We have revenue on the Y axis, and as it's going up, it's a function of units sold. So the more units you sell, the revenue is going up, which is the line right here. Now, we also know that we have variable costs and fixed costs. So if we draw this line right across here, you can see if we're selling something and we're not covering both the variable and fixed costs, we're losing money. So this is the point where our fixed cost plus the variable cost times the unit are equal. Then the more money, the more units we produce, we know the variable costs are going up, but the fixed costs remain fixed, and thus profits go up. So we want to identify this optimal range here that we can make to maximize our profit, okay, within this fixed cost horizon. So you're going to see me jump around between graphics, which I like, it's simple for me, and the long-term narrative, which I'm not going to read. I'm just going to let you figure it out. Here is an example. Fixed cost 90, unit selling price 25, unit variable 15, so the contribution margin is 10, and the break-even point is 9,000 units, which is fixed costs 90 divided by the unit contribution margin. Because that's what we have left over to cover it, we need to produce a minimum of 9,000 units. Okay. Now, a lot of it is done in units because that's how a company's run, is based on producing units. Molson Coors doesn't just look at the dollars; they got to look at how much is the production in the volume metric, the hectoliters. So we can do the same thing: break even in sales, which are total fixed cost divided by the contribution margin ratio, and that gives us the we can determine the break-even sales point. To compute the contribution margin ratio, we take the unit contribution margin divided by the unit selling price. All I'm doing on these is taking and replacing dollars where we have units. Okay?